Welcome to Word on the Beach, Green Street Advisors' monthly market insights for August 2010. Joining me via video conference from Green Street's Newport Beach headquarters is Stephen Frankel, head of the firm's industrial sector team. Stephen, can you tell us a little bit about the current state of operating fundamentals in the industrial sector?
Operating fundamentals remain under some pressure globally, while we've seen strong rebounds in industrial production and trade since early last year. The weak pace of inventory replenishment and recent sluggish macroeconomic data points indicate that a rebound has not yet materialized. In the U.S., we believe that occupancy is likely at or near a bottom, but rents could remain under some pressure for some time. Europe is a region that we also track, and in Europe, conditions remain weaker than in the United States, where net absorption is unlikely to turn positive until 2011 at the earliest.
So what do you think that the recovery in the sector will look like?
Since industrial warehouses serve as the temporary storage home for goods, trends in inventory restocking and consumption are key demand drivers. At Green Street, we view the economy through a new normal lens and believe that economic growth and consumption are likely to remain under pressure relative to what we saw in prior cycles, since the U.S. is undergoing a deleveraging cycle and consumers are likely to pay down debt instead of spend. At the same time, retailers are embracing a business model focused on cost containment and just-in-time inventory. Unless these trends are reversed, we believe that the pace of the recovery will likely be subdued to what we saw during the early 2000s.
Do you think that the recovery will differ between inland and coastal markets?
Well, we believe that coastal markets are likely to outperform inland markets for a few reasons. First of all, during the second quarter, we saw vacancy tick down in a few select coastal markets, whereas vacancy continues to tick up in inland markets. In addition, coastal markets have lower vacancy rates by a couple hundred basis points relative to inland markets, which should let landlords in those markets push rents faster. Third of all, and perhaps most importantly, coastal markets tend to be home not only to the ports, but also to large population centers, which are likely to be more resilient as sources of demand than the broad-based consumption needed to support warehouses in the middle of the country.
And in this type of environment, what kind of opportunities are out there for industrial REITs?
Historically, industrial REITs have focused on speculative development to add value, but spec development does not currently pencil and may not pencil for some time. There still remain other opportunities, however, for industrial REITs to take advantage of, notably on the acquisitions and fund management sides of their businesses. On the acquisitions front, competition has increased over the last few months in coastal markets for core prime real estate, but there remain opportunities to acquire value-add or secondary properties at significant discounts to replacement cost. In addition, private capital is starting to return to the industrial warehouse market, and that should let REITs that have credible and sizable asset management platforms raise new capital.
Thanks, Stephen. For more information on this and other REIT news and analysis, check out REIT.com.